Marifa.
Debut International Sukuk in Saudi Arabia. Saudi Arabia's debut international bond issuance of $17 billion in 2016 was one of the biggest issuances in the GCC sector to date, and in order to widen their investor base, they joined the international Sukuk industry in 2017 with a record issuance of $9 billion. It is said to be one of the most liquid Sukuk, and it is the first time a sovereign has chosen to have a hybrid dual tranche structure for their international debut. The certificates are traded on the Irish Stock Exchange, while the investor meetings were arranged by Citigroup, HSBC, and JP Morgan, who were accompanied by BNP Paribas, Deutsche Bank, and NCB Capital as lead managers and book runners. The kingdom will use 49% of its proceeds to buy and sell Islamic commodities for its general budgetary purposes, and the remaining 51% will be used to finance infrastructure projects in the region. Murabaha, a form of contract where the payment is deferred for future date in installments. Mudaraba, a form of venture capital where one party contributes the capital and the other party its services for a particular project. In this form of contract, Rabul Mal is the capital provider and the Mudareb is the service provider. There are three parties involved in this transaction: KSA Sukuk Limited, acting as an issuer, trustee, and primary Rabul Mal or capital provider; the kingdom, acting as a purchaser and as an infrastructure Mudareb; Saudi Arabian Sukuk Company, acting as a primary Mudareb and infrastructure Rabul Mal. Murabaha Agreement. Murabaha proceeds will be used by the KSA Sukuk Limited to buy commodities through a commodity broker and sell it to the kingdom. The kingdom then sells them to a different commodity broker in the market and repays KSA Sukuk Limited on a deferred payment basis. Finally, the profits from the deferred sale will be made to the investors, and the principal will be paid during the maturity of the contract. Mudaraba Agreement. The KSA Sukuk Limited will be acting as a primary Rab ul Mal and will provide the capital to the onshore investment vehicle, who is the Mudareb. The Mudareb will then invest in a further Mudaraba agreement and become the subsequent Rab ul Mal and provide the capital to the kingdom for its infrastructure needs. The returns generated from the infrastructure projects will be transferred to investors in the form of coupon payments. Overview of Saudi Arabia's economy. In 2016, Saudi Arabia's real GDP was $688.2 billion, representing growth of 1.4% in real terms, as compared to real GDP of $678.7 billion. For the year ended 2015. Saudi Arabia's nominal GDP was $639.6 billion for the year ended 31st December 2016, as compared to the nominal GDP of $651.8 billion for the year ended 31st December 2015. As of 31st December 2015, Saudi Arabia possessed the world's second-largest proven oil reserves, accounting for 17.9% of the world's total oil reserves, and was the world's largest oil producer, accounting for 13.6% of the world's total oil production. While the oil industry has continued to be the largest part of Saudi Arabia's economy, for the past several years, Saudi Arabia has also been concentrating on the diversification of programs for its economy. The diversification plans had gained special momentum in mid-2014 due to the sharp decline in oil prices, and for the same reason, the kingdom had its budget deficit equal to 2.3% of Saudi Arabia's nominal GDP for the year ended 31st December 2014. The following year, this budget deficit had a spike of 15% compared to last year. Due to the continued deficits, The kingdom resumed to issue their Saudi-denominated domestic bonds in 2015 and increased their bank borrowings as well. The following year, they issued their first dollar-denominated bonds to the international investors, which were one of the biggest issuances in the Gulf region. Key risk factors. Regulations. According to U.S. regulation, the Volcker Rule defines the above structure as a covered fund, and this may negatively affect the liquidity and the value of the trust certificates, as it restricts banking entities from investing into certain credit-related instruments, which are speculative and risky. Economic condition. As the Saudi Arabia economy is based on oil exports, lower oil prices may affect the kingdom's ability to fulfill its obligations. Political standing and defense spending. Political stature and security is a big concern, as several countries around the region are currently subject to armed conflicts, social and political unrest, including disturbances in Yemen, Syria, Libya, and Iraq. Such events may also contribute to increased defense spending, which in turn could have an adverse impact on Saudi Arabia's fiscal position or the budget available for other projects. Credit rating. The ongoing political conflicts, terrorist attacks, and the Arab Spring crisis, started in 2011 in the region, has increased political uncertainty across the region, and due to this fact, the sovereign credit rating of the kingdom might be downgraded in future. Secondary market. There may be an inactive secondary market for the certificates, which will lead to more volatile prices than conventional securities. Hence, illiquidity will have adverse effect on the market value of the securities. Sharia compliance risk. The Sharia advisors of the above said book runners have each approved the transaction structure and confirmed that in their view the certificates are compliant with Sharia principles. However, there can be no assurance that other Sharia boards or Sharia scholars will agree with the views of the scholars. Legality. The legality of the trust certificates will be governed by and constructed in accordance with English common law. There are two SPVs in the program, the onshore and the offshore. The onshore SPV will be governed by Saudi law, and the offshore SPV will be governed by common law. Any dispute arising out of the certificates will be termed as dispute, and will be resolved by arbitration under the arbitration rules of the London Court of International Arbitration. Pricing. The order book was oversubscribed by 4 times, signaling immense demand for the papers. The deal size was finalized as $9 billion, and the final spread was fixed at mid-swaps plus 100 BPS and mid-swaps plus 140 BPS, yielding at 2.894% and 3.628%, split evenly across the 5-year tranche and 10-year tranche, respectively. Ratings. Moody's have given the Trust Certificate Program an A1 rating, and Fitch has given an A+ rating. Fitch is of the opinion that the kingdom will be required to ensure full and timely repayment due to its roles and obligations under the Sukuk structure and documentation.
معرفة.